In this video, we're covering the main retirement account options for self-employed or small business owners. So if you're a freelancer, this video is for you. Now there are 5 main choices when it comes to these. You have the solo 401k, the SEP IRA, the Roth IRA, traditional IRA, and a simple IRA. If you want a full overview, make sure you visit irs.gov as well for additional information. Let's start with the first option, solo 401k. The solo 401k is a tax-advantaged retirement savings plan available to individual small business owners and their spouses. It is a variation of the 401k plan that many large employers offer their workers. Since it is a 401k designed for business owners with no employees, the employer and employee are one and the same, which means that the retirement contribution limits are higher than the traditional plans. The contributions made as an employer are tax deductible, which can save the sole proprietor in taxes. The solo 401k is available to owner-only small businesses, including corporations, LLCs, and partnerships. The only other participants can be business owners' spouses, as long as they work for the company. Plans do not qualify if any outside or additional employees are hired. If you work for a company in which you have no ownership and participate in its 401k, you can also establish a solo 401k for a small business that you run on the side as a side gig. The solo 401k can be funded with earnings from the small business, but the aggregate annual maximum contributions to both plans cannot collectively exceed the IRS established maximums. If your business is not incorporated, you can generally deduct contributions for yourself from your personal income. If your business is incorporated, the contributions can be counted as a business expense. There are no income limits to participate in a solo 401k. Now, with a solo 401k, you can make employee contributions of up to $20,500 in 2022. If you're 50 or older, you can put away an additional catch-up contribution of $6,500 each year as well. As the business owner, you can also make an employer contribution up to 25% of your company's profits, up to a total deposit of $61,000 between the two for 2022. If you max out the employee contribution of $20,500, that means you can only contribute another $40,500 through employer contributions. When it comes to withdrawal rules, there are 2 versions of the individual 401k plan, or the solo 401k, the traditional version and the Roth version. In the traditional solo 401k, tax-deferred money is only taxed when money is withdrawn, just like a traditional 401k plan or a traditional IRA. Withdrawals are taxed at your marginal income tax rate, and there's no penalty for withdrawals, as long as the distributions are made at age 59.5 or older. On the other hand, in the Roth solo 401k version, you do not pay taxes on withdrawals as long as they're taken after 59.5 because you set aside after-tax money. The money was already taxed. Now, when it comes to pros and cons, the solo 401k gives you all the advantages of a company 401k plan and then gives you even more benefits. You can select traditional or Roth 401k options, meaning that you'll get the ability to contribute before tax or after tax dollars. That flexibility is kind of nice. You can invest in virtually any types of investment as well. And if you pick a low-cost broker, you can avoid the traditional 401k plan fees, which really add up. Solo 401ks are generally cheaper to establish and maintain, and participants are able to borrow against their balances, just like the traditional 401k option. Who is this best for? Well, one-person businesses are those with one person and a spouse, first off. It also may work well for those with a side gig or just earning a lot of money in their business. If you want more tips like this to grow your wealth, pay off debt, and learn all the financial 101 tools that maybe we weren't all taught in high school and college, hit subscribe and follow along. Let's go to the SEP IRA. A simplified employee pension is an individual retirement account that an employer or a self-employed person can establish. The employer is allowed a tax deduction for contributions made to a SEP IRA and makes contributions to each eligible employee's plan on a discretionary basis. SEP IRAs are available for a variety of small business types, including sole proprietorships, partnerships, LLCs, S-corps, and C-corps. The plans can be an especially attractive option for a small business with just a few employees. Unlike some other retirement plans, a SEP IRA allows only the employer to contribute, which in the case of a sole proprietorship is the employee as well. The employer contributes pre-tax funds into the plan on behalf of the employee, and funds then grow tax deferred. To be eligible to participate in an employer SEP IRA, Employees must be at least 21 years old, have worked at the business for 3 of the past 5 years, and have earned at least $650 from that job in 2022. Because the funding vehicle for a SEP plan is a traditional IRA, SEP contributions, once deposited, become traditional IRA assets and are subject to many of the traditional IRA rules, including income limits. The amount of compensation you can use to calculate the 25% limit is limited to $290,000 in 2021 and $305K in 2022. You can still make over that amount as the employee, but any income above that limit cannot be used in that 25% calculation. Contribution limits. Contributions made by employers cannot exceed the lesser of 25% of an employee's compensation, or $61K in 2022. When a business is a sole proprietorship, the employee owner pays themselves wages and then may also make a SEP contribution, which again is limited to 25% of wages or profits minus the SEP contribution. Withdrawal rules. As with a traditional IRA, withdrawals from SEP IRAs after 59.5 are taxed as ordinary income. If a participant makes a withdrawal before age 59.5, generally a 10% additional tax applies. SEP contributions and earnings may be rolled over tax-free to other IRAs and retirement plans as well. So what are some of the pros or cons of the SEP IRA? SEP IRAs often have higher annual contribution limits than standard traditional IRAs. In a sense, they're a cross between a traditional IRA and a standard 401k, in the sense that, like the latter, they can receive employer contributions. Also, even if you participate in a retirement plan as a self-employed individual, including the SEP IRA or Simple IRA, you still have the ability to participate in a traditional IRA or Roth IRA. So who might the SEP IRA be best for? It might be best for the high-earning self-employed, especially those in one-person sole proprietorships. That begs the next question though. Should you do a solo 401k or a SEP IRA? The solo 401k allows you to contribute up to 100% of your salary, up to the employee's annual maximum. In other words, in 2022, the first $20,500 that you earn can be put away in the solo 401k, saving you on taxes right up front. Now in contrast, the SEP IRA allows you to contribute at a 25% rate, so you have to earn a lot more to reach the same contribution level. The solo 401k also allows you to max out the employer contribution. And once you hit the employee maximum, you can still contribute at a 25% rate from your company's remaining profits, up to the annual maximum. So in contrast to the SEP IRA, you're able to contribute more to your retirement plan at a lower level of income in the solo 401k, all else equal. However, they're both great options for small businesses. Simple IRA. A simple IRA is a retirement savings plan that most small businesses with 100 or fewer employees can use. SIMPLE stands for Savings Incentive Match Plan for Employees, while IRA is obviously the acronym for Individual Retirement Account. Employers can choose to make a non-elective contribution of 2% of the employee's salary or a dollar-for-dollar matching contribution of the employee's contributions to the plan up to 3% of their salary. Either way, employers are required to contribute at least the minimum amount of 2%. To be eligible to establish a simple IRA, the employer must have 100 or fewer employees. Those who are self-employed or sole proprietors are eligible to establish a simple IRA as well. To participate in the plan, employees must have earned at least $5K in compensation in any of the 2 previous calendar years and be expected to earn at least $5K in the current year. Contribution limits. Employees can contribute a maximum of $14,000 in 2022, and those over age 50 can make an additional catch-up contribution of $3K, bringing their annual maximum to $17K for 2022. Withdrawal rules. The Simple IRA uses the rules of a traditional IRA, so it's tax-deferred and has the same withdrawal requirements at retirement. Pros and cons of this. The appeal of Simple IRAs is that they have minimal paperwork requirements, just an initial plan document and then annual disclosures to employees. The employer establishes the plan through a financial institution that administers it. Startup and maintenance costs are low, and employers get a tax deduction for contributions that they make for employees. One drawback of the Simple IRA is that the business owner cannot save as much for retirement as with other small business retirement plans, such as the SEP IRA or solo 401k plan. So who is the Simple IRA best for? It might be better for businesses with at least a few employees, maybe 5 plus, but want to offer a lower total retirement benefit than the other plans do. there's not as much benefit there, but it might work for some. The Roth IRA. The Roth IRA is a type of individual retirement account that allows you to contribute after-tax money for tax-free withdrawals under certain conditions. And when we say after tax, right, we just mean this is the money that's paid to you in your paycheck that's already been taxed. Funds in your Roth IRA grow tax-free, and when you take qualified distributions, you are not responsible for any additional taxes. Your contributions are already taxed, so you can withdraw these at any time without any taxes or penalties. To be eligible to contribute to a Roth IRA in 2022, single tax filers must have a modified adjusted gross income of $144,000 or less, which is up a little bit from 2021. If you're married and filing jointly, your joint modified adjusted gross income must be under $214,000. If you're over these income limits, you likely cannot contribute to a Roth IRA directly. Contribution limit. You can only contribute up to $6,000 per year to a Roth IRA as of the year 2022. And if you're over 50, you can contribute another $1,000 for a total of $7,000. Now keep in mind that these contribution limits apply to the combined contributions between your Roth and your traditional IRAs. Withdrawal rules. Your contributions were already taxed, right? So you can withdraw these at any time without any taxes or penalties. And this is worth repeating, I've said it a few times now. You can withdraw your contributions from a Roth IRA at any time, no matter what, without any taxes or penalties. It's really only earnings that really matter when it comes to withdrawals. However, we should also say, you should not open an IRA, especially a Roth IRA, with a plan to withdraw your money before retirement, since removing your money could mean missing out on compounding, on time, on big market gains potentially. So early withdrawals, even if you're not penalized with taxes, should still be thought of as a last resort. If you withdraw earnings and your account is over 5 years old and you're over 59 and a half, those are also tax-free. However, if your account is less than 5 years old and you withdraw earnings, you might be subject to taxes and penalties if you don't meet the requirements for a qualified distribution. The earnings would be taxed according to your ordinary income rate and incur an additional penalty of 10%. Here's an example. If you have contributed $20,000 to your Roth IRA over the years and it is now worth $25,000, your account has $20,000 of contribution and $5,000 of earnings. You can withdraw up to $20,000 at any time because you have already paid taxes on it. However, if your withdrawal exceeds that amount and dips into the $5,000 of earnings, you might be subject to these taxes and penalties. If you're purchasing your first home, you can withdraw up to $10,000 in earnings tax and penalty free. And if you want to learn more about the additional qualified withdrawals, we'll provide a link in the description below. Who might the Roth IRA be best for? Well, if you're covered by an employer-sponsored plan like a 401k, or I guess even if you aren't, and you make under the IRS income limit that we discussed, the Roth IRA may be best for you. As your income increases throughout your career, you may no longer be eligible to contribute to a Roth IRA, so I'd consider prioritizing this retirement account first. Traditional IRA. A traditional IRA allows individuals to contribute pre-tax income towards investments that can grow tax-deferred. Whereas the Roth IRA gives you the tax benefit upon withdrawal, the traditional IRA allows you to deduct your contributions from your income for tax purposes. You then pay the taxes upon withdrawal. The best way to think about this is, with the traditional IRA, you take the tax benefit up front by deducting your contributions from your income. Funds in your traditional IRA grow tax-deferred instead of tax-free. So when you withdraw the funds, you owe taxes on the full amount. So this tax break, it's on the front end for those that want to save taxes on their income now, as opposed to the Roth IRA, which you save taxes on the withdrawal. Contribution limits. Contribution limits to the traditional IRA are the same as the Roth IRA, as these limits apply to the total amount of contributions across your traditional and Roth IRAs. You can only contribute up to $6,000 per year to a traditional IRA, and if you're over 50, you can contribute another $1,000 for a total of $7,000 between the two IRAs. Eligibility. This one gets tricky. To receive the full benefit of the traditional IRA, you can only deduct your contributions from your adjusted gross income if neither you nor your spouse have access to a workplace retirement plan like a 401k. If neither of you do, you can deduct all of your contributions and there is no income limit. This is important to understand as the traditional IRA's real benefit is through this tax deduction up front. If you can't deduct your contributions, then it's really not valuable. Income limits. If both you and your spouse have access to a 401k plan through work, things then get tricky. To be eligible to fully deduct your contributions, your adjusted gross income must be less than $68,000 as a single filer or $109,000 as a joint filer for the year 2022. If only one of you has access to a workplace retirement plan, like that 401k, your adjusted gross income must be less than $204,000. Withdrawal rules. Your contributions were not yet taxed, so when you withdraw them, they are treated as ordinary income and you owe taxes no matter what. If you withdraw the funds after 59.5, there's no additional 10% penalty. You just owe taxes on the withdrawal according to your ordinary income tax rate. If you do withdraw the funds before 59.5, you may owe that 10% penalty. However, like all IRAs, there are exceptions to the rule called qualified distributions. If you want to learn more about that, we'll add a link to another video below. One common way to do this is if you're purchasing your first home, you can withdraw up to $10,000 in earnings penalty-free. You only owe ordinary income taxes on the full amount. Who would a traditional IRA be best for? If you're not covered by an employer-sponsored retirement plan like that 401k, the traditional IRA could really help reduce your taxable income in the current year and then increase your retirement savings down the road. As there are no income limits if you are not covered by an employer plan, this tool can be used no matter how much you make each year. Thanks for watching. This is Tony from Wealthfront. Check out this next video.